Hey there, it's Terry Sawchuk from Sawchuk Wealth. It's Thursday, so that means it's time for 3-Minute Thursdays. I want to talk about the fiscal situation that we're dealing with, the Fed testimony yesterday, equity prices, and some recent moves that we've made in our models. Let's start with the Fed testimony. Yesterday, Jerome Powell came out dovish, just like he did in December, and talked about still the potential for 3 rate cuts before the end of the year. So that's interesting. It's supportive for asset prices. It's probably not great for the US dollar. It's probably good for gold. It's probably good for commodities, things that are going to be typically, not always, but typically inversely correlated to the US dollar. So if we continue to spend money and the Fed keeps liquidity high and financial conditions relatively loose, the dollar arguably should weaken, and that should push these other things higher. So in our advisory model, on a very small basis, we added some commodity-driven assets like uranium, gold, oil, and then we also added European banks just because they're so depressed that they're selling at around 50% of book value. So, we're likely to see, even if it doesn't go up a lot, it shouldn't go down, but I think there's some pretty decent price appreciation potential there, especially if in Europe rates start to go up a little bit. That'll tend to be good for banks. Some other things that, it kind of reminiscent of last year around this time, it was in March, another bank got bailed out, not by the feds, but a conglomerate of banks put together about $1 billion rescue package for a bank in New York. And it's interesting because, it really was outside of the FDIC. And it begs the question, why didn't the FDIC get insured or insurance get involved there? So, we're keeping an eye on that. That's an interesting turn of events. Commercial real estate is still, the elephant in the room. And although it's not on the doorstep right now, it's getting closer. And so I think, that could be one of the reasons why the Fed's keeping financial conditions a little looser. And Powell is talking about maybe, 3 more rate cuts this year. Because I do think that they are well aware that commercial real estate could be a big problem. But the market, shrugged off it. It had a day where it was down a little over 2% earlier this week. And, as of this morning, the S&P was brushing up against all-time highs and touching on intraday highs. So, the market seems to have liked what Powell said. It's a populism election year. Typically, when you have populist elections, the market does a little better. And the fact that the federal government is just spending money like crazy, that tends to be supportive of stocks that go up. So this could be a year where it's a little better than we thought it would be in the beginning. There's still risks. And these ODTEs, these 0 days to expiry options, in a lot of ways smooth out volatility. But in some instances, if you hit the right series of events, they could turn catastrophic really quickly. So any equity positions that we're holding right now are very aggressively hedged, but we want to participate. We don't want to take a lot of risk in the process. So that's kind of where we're at right now. We'll circle back next week on 3-Minute Thursday. Hope you have an awesome rest of the day and a great weekend, and we'll see you next week.